the obvious one is artificial intelligence, and I know it's getting a lot of press, um, and not to overhype it, but there's some real powerful economic trends around it. The biggest example of that is NVIDIA, which is this large cap semiconductor company whose revenue is literally growing nearly triple digits, and it's now a $1 trillion market cap. So that's somewhat indicative of how powerful this trend is. Microsoft would be another example where they're monetizing artificial intelligence by creating Copilot functionality to help their users harness the power of artificial intelligence. So how this is expressed in global discovery is there's the first order effects. So the semiconductors that are used to crunch all this data to create this AI algorithm. Examples in global discovery down the market cap spectrum would be Lattice Semiconductor, Monolithic Power. In networking, we own Arista Networks, which is a beneficiary of moving this data around. Those would be first order effects. The second order effects would be when you think about what's required for artificial intelligence, you need a modern infrastructure. So we believe our software providers are well positioned for that. Companies are going to accelerate their monetization efforts of their tech infrastructure in order to take advantage of the power of artificial intelligence. We own some software companies also that will eventually monetize it through more Copilot functionality like Microsoft announced. And they'll benefit in terms of their developer productivity because they'll use artificial intelligence to help their developers develop more efficiently. So it's been overhyped arguably, but we think the economics are really powerful. We think it's a big multi-year trend, and it's really started to manifest itself in this last quarter. A second trend that I'd highlight is the need to invest in our grids. So when you think about the world adopting renewable energy, when you think about the world electrifying lots of different things like automobiles, that's creating a lot of stress on electricity grids. And just to put some numbers around this and the way to think about it and the way to think about how we're thinking about the trend. So Tesla is busy pushing down the price of the electric vehicle. That's causing adoption to move up. Today, when you buy an electric vehicle, it automatically doubles the electric load in your home as you charge it. If you add a heat pump to your home, that adds another 50%. So you can think as the price of these electric vehicles come down and people move from 1 to 2 in their home, it has a dramatic impact on the electric load and our electric infrastructure generally. Norway is the most electrified country in the world, and their per home electricity usage is 3x a country like Germany's, as an example. And so we think this is a trend that's just getting started. We own a number of companies that are what I would call lowest common denominator beneficiaries of this. They supply equipment into this trend. So Wesco is a distributor. Bentley Systems is a software company that's used to help engineers create infrastructure projects. Hubble is a manufacturer of electric components and equipment that sells into utilities. So those would be two of the bigger trends that we've observed over the last 90 days. In terms of what worked and what didn't, I think our biggest performers were companies like Nubank, which is a digital-only bank in Brazil that is disrupting a oligopoly. So the Brazilian banking market is very consolidated. There's only 4 banks. And that means the customer service is poor. It means their tech infrastructures haven't been invested in. It means their APRs on their credit card offerings are very high. Nubank, because they have a modern tech platform, they don't have branches. They've been able to introduce at first a credit card that was very disruptive. and take advantage of their lower cost to create a value proposition that was very attractive to the consumer. So they've been growing nicely for a while, but the profitability really inflected during this latest quarter, and so the stock followed that profit acceleration. So that was one of our better performers during the quarter. I mentioned Bentley Systems when we were talking about trends. Bentley is a software provider. They sell software into civil engineers, as civil engineers are creating roads, bridges, utility projects. That's a very scarce resource in many parts of the world. And so Bentley provides much needed productivity. They're able to monetize that through pricing. That was also another nice contributor in the second quarter. And in healthcare, we have a medical device company called Shockwave that makes a cardiovascular device that's used, and they received approval for their latest device, and so that the stock reacted favorably to that. In terms of what didn't work, one of the biggest detractors during the quarter was a biotech company called Ascendis. And just the way we invest in biotech is the company has to have an approved drug before we would consider investing in it. We're not going to invest in a biotech without an approved drug because we can't underwrite a valuation without an approved drug. In the case of Ascendis, they have that approved drug. It's actually doing quite well on the market, but their second indication, leveraging their tech platform, was expected to be approved in the second quarter, and the US FDA delayed approval of that, and the stock reacted negatively to that. As we looked at the data, both the efficacy and the safety data, and through our interviews with experts, we've been compelled by the second indication. But the issue the FDA has had with it is a manufacturing issue. And so the company believes that they'll be able to rectify that within a year. So it's disappointing that the drug got pushed out in terms of commercial approval for a year, but the stock took its medicine for that, and we're still just as compelled by that opportunity. And so we held on to Ascendis because we still think it's a very attractive investment over a 3 and 5 year period of time. Another big detractor in the fund was a company called Merrill. This is a company that's headquartered in Iceland, and they're the global leader in systems and equipment to help process protein, so beef, chicken, fish. Our profit cycle thesis was their customers would invest to upgrade that equipment in light of labor shortage and in light of the need for more sophisticated track and trace functionality in terms of how they process these proteins. That thesis, at best, has been pushed out. The company reported poor results in terms of their orders, in terms of their profit margins. And so it was a small position. It's what we call a garden position, where we start with a company that has a competitive advantage, but where we're testing a profit cycle thesis. And in our judgment, that profit cycle thesis probably looks wrong. And so we moved on from Merrill as a result of that earnings update. Yeah, we've been active, both being opportunistic by what the market gave us, and also finding some ideas that we think are very well positioned for a multi-year secular trend. So I talked about the need to modernize electric grids globally. One of the companies we added to the portfolio in a small way during the quarter was a company called Wesco, which is the largest distributor of electrical equipment in the US. They're also the largest distributor of data center equipment in the US. So we think they're very well positioned to benefit from this increased demand of equipment that needs to be put in place in in transmission, distribution, in the home. In addition to that, they, as a distributor, having a scale advantage is important. They acquired one of their most significant competitors a couple of years ago, and they are now nearly 2x the size of their nearest competitor here in the U.S. And that shows up in their margins and their returns. And we think there's more of that to come as they realize more synergy from that combination still, and ride the secular trend. So that would be one that we added. Another one we added is a company called Sartorius. It's a German bio-equipment company. And they provide filtration equipment to pharma companies that are producing biologic drugs. And we like that biologic drug development trend because it's still relatively early in its life cycle. If you look at the number of drugs on the market that are biologics, it's about 30%. But the number of drugs in pharma's R&D pipeline that are biologic is 80%. So that's a trend that's going to continue for a number of years. And Sartorius think of it as an arms dealer into this trend. And once they're qualified, it's very sticky. They have a very, very strong pricing power, very high barriers to entry. The issue is, despite the strong secular trend, there's been an inventory correction cycle as a result, really, of the COVID hangover and all the investment that was put into pharma production. And Sartorius was affected by that. But we still really like how durable their competitive position is, and we still have a lot of confidence in that trend. The stock has been hurt over the last 15 months as this inventory correction cycle has played out, and it got to a valuation point in the last quarter that we thought was compelling. And so we added it to the fund with the idea that we'd add to it into this temporary inventory correction cycle to acquire it at an attractive cost base for what was a really good company with a great long-term trend and great earnings power. So those would be two of the additions. In terms of the trims, we did a number of trimming on valuation. So we're going to invest in quality companies that have a identifiable profit cycle with valuation we understand. The market's been up nicely year to date, and there's a couple of our holdings that have got to the upper end of our valuation framework. And as a long-only investment manager, one of the only ways we have to mitigate risk is by taking incremental capital away as it breaches those valuation parameters. So examples of that during the quarter would have been HubSpot, would have been AMD, would have been Zscaler. So those are all names that we trimmed back but did not eliminate from the fund because we would buy them on a correction because we like the longer term. We just think, based on our valuation work, the risk reward on a forward 12-month basis wasn't attractive relative to other names in the fund. In terms of names that we eliminated from the fund, so I mentioned Merrill. Another one that we eliminated was a company called Novanta. So Novanta makes motion control equipment, and it's a company we've owned for 5 years. It has half its sales into healthcare, half into industrial automation type applications. Stock's done really well, but it got to a point where the valuation did not make sense to us, and we see the core organic growth slowing over the coming years. Not that it's going to turn down in a significant way, but relative to where the stock was priced, we didn't see that as a good risk reward, and so we exited Novanta completely. A final name that I would mention that we exited was a company called De Nora. It's an Italian company that makes electrodes, and they're the market leader in electrodes globally. And electrodes are used to make in different chemical processes. But what we liked about it was, as the leader in this market with strong profitability, we thought that they were well positioned for the hydrogen economy. So hydrogen is used to store renewable power in some cases, and to help and perhaps be a power source even. And so we liked De Nora because it was a market leader, had strong profitability. When you look at a lot of these electrolyzer companies, they are very loss generating still. And we didn't, we have to believe that there's a true profit cycle to invest in a company. But what we found out is, as we did more work, is you needed vastly more renewable energy to take advantage of green hydrogen. And the other thing we learned is the electrolyzers that De Nora would supply electrodes into had a lot more work to scale their technology. And so we just realized we were way too early. The stock has moved up a lot from where we had initiated it because there is some hype around this green hydrogen opportunity. We think that's going to come crashing down at some point. We don't know when, but we think the profit potential from this trend is 3 to 5 years out still. And so rather than, really not believe in it, we exited the position and moved on. The way we run our strategy is we're looking to concentrate the capital in the top 20 positions. And we're really excited about those top 20 positions. So the top 20 today is about 60% of the capital in the fund. And let me just talk about 2 of our top 5 positions. So 2 of our biggest positions, we're really excited about them. One would be ON Semiconductor. So ON is the leading provider of silicon carbide power management semiconductors. So silicon carbide is a special material. Most semiconductors are produced on silicon. Silicon carbide is a much harder material. And what's attractive about it is it solves the electric vehicle range problem. It helps solve that problem. So one of the big, headwinds to electrical vehicle adoption is range anxiety. People don't want to buy an electric vehicle because, they're worried about how much range they'll really have. And silicon carbide is a material that adds range because of its properties. And ON Semiconductor is the leader not only in producing that material, but also creating the semiconductor device on top of that material, the power management chip that goes into the electric vehicle. So they have deals with virtually all the big auto companies that are producing electric vehicles. They also have long-term deals with 8 of the top 10 renewable energy producers because this technology is attractive to those companies as well. It's also a company that has a new management team, and they're doing a great job of focusing on this area and getting out of less profitable areas. And as an example, they sold 4 of their manufacturing fabs last year, so they're becoming asset light. They're focusing on higher margin parts of their business. So we think this is a company that can grow their revenue at double digits for the next several years based on these secular trends. We think their profits are going to grow faster. We think there's margin expansion potential of 500 to 1,000 basis points, so really attractive margin expansion. That equals very attractive earnings growth, and the stock on our numbers is trading at about 17 times next year's earnings. And so we just think that it's been a nice stock for us year to date, but we still think it has very big potential over the coming years. Another example in our top 5 would be a company, Gerresheimer. So Gerresheimer is a German pharmaceutical packaging company. And this is also a company that's benefiting from a new management team bringing focus. So the new management team got there about 5 years ago now. They immediately started investing in R&D to make their products, which are things like plastic and glass packaging, test tubes, syringes, auto injectors. They immediately started investing to make their products better for biologic drug manufacturing because they can earn higher prices for those. So think about ready to fill vials, think about pre-sanitized glass tubing. Think about auto injectors that are used for what's called GLP-1 obesity drugs. So this is a topic that's in the news, and they're very well positioned to benefit from that trend because they're one of three that make the auto injectors that's used to apply the drug. So this is another situation where we think the company is going to grow at strong double digits in terms of their revenue over the next several years. And as they harvest that R&D spending they've been doing for the last 5 years, and where again the margins can go up by 300 to 500 basis points, and so that's going to drive very strong earnings growth. And the company's trading at about 19 times of what we estimate next year's earnings are, which we think is very compelling. And so that's another one that we're quite excited about looking out over the next several years, and it's why it's in our top 5.